What are the key takeaways for you from the results we've seen in the first quarter?
Well, anyone who's been following us will know that we were anticipating a relatively slower start actually to the year, just because, you know, of the elections. I think that on the whole, the results have been perhaps a touch more robust than we were expecting, although some of the guys that we have some reservations about are still showing signs of underperformance. Some are explainable, you know, or have been explained somewhat in the case of Diamond, and others in the case of sort of UBA. We are just less upbeat about their performance.
But one of the things that I think is somewhat common is loan growth. I think that is beginning to pick up.
Yes, yes, and that for us is something that I think has been at the higher end of our expectations. We expected a relatively slow start because, you know, people were somewhat distracted by other things. But I suppose the resounding primary victory for Jonathan at the back end of early in the year perhaps abated some of those concerns. But nevertheless, I think that loan growth has been, on the whole, so the tier 2 banks particularly delivering, some of them delivering sort of loan growth in the 20s, is definitely stronger than we expected.
And let's talk a bit about net interest margins. Obviously, we're in a higher interest rate environment, and it's expected that we might even get even higher going forward into the rest of this year. What does that mean for the banking sector in your view?
Well, I think that there is an acknowledgement across the board that there will be some pressure on net interest margins, but I think it also is that there will be some repricing, I think, for assets at the higher end of the spectrum. You know, in 2009-10, the tier 1 corporates were enjoying, being in a sort of a buyer's market, as it were, and they had, a lot of leverage with banks. But I think that as we move through this year, as banks begin to draw down on their liquidity that they've sort of stored up, the standing deposit facility at 5.5 is relatively attractive. So the competition for funds, I think, begins to grow, and I expect that to manifest itself in some repricing at the higher end. But we're also seeing strategically banks talking about diversifying the mix. So sitting down with the likes of the UBA that typically have referred to themselves as a very safe lender in terms of the counterparties they choose, are now acknowledging actually that they need to change that mix, and that the sort of lower quality or tier 1 kind of commercial, rather than the sort of blue chip, will make up around 20% of their loan book when they are done with their rebalancing, and similarly consumer will make up a further 20%, up from around 13% now. So there is a sort of a movement towards exploring other segments of the space, which will also help to preserve margins.
Well, given the environment as a whole, obviously we have operating expenses rising. I think we've seen that in a few of the results we've seen so far. Inflation is high. There's definitely pressure on the cost side. In your view, what is the perhaps general winning strategy in the market environment, given the slow pace of loan growth and, of course, the high interest rate environment?
Well, I mean, I think slow loan growth is perhaps a bit harsh relative to what we experienced in the wild west days.
Yeah, I agree.
But I think that this time around, at least, banks have been more focused on efficiencies than if we roll back 3 years ago. They were less so. So they're perhaps better equipped to deal with it. I think many banks have spoken about concerns with certain operating expenses. They have perhaps not so much room to maneuver on, like diesel costs, as we've seen. The oil price remaining high, that does feed through for them.
Indeed.
But they're monitoring it, and I think it's something that they will seek to adjust. Other elements of their cost base in light of. If there's not much movement on some of these immovable things, they'll have to sort of tighten their belts elsewhere. But there is upward pressure on costs, without a doubt. But I think that on the asset side and on the revenue side, things are looking much better than they did in 2010. And so, I think that it's not a desperate concern, but it's something to watch.
And a quick final point: where do the rescued banks fit into the whole scenario this year, in your view? I know you guys are not rating them right now, but
no, we're not.
What are your thoughts on the impact that they will have, given the fact that, yes, they will be recapitalized, we might see some M&A? How does that fit into the whole sector, very quickly?
Well, I think that is perhaps more of a 2012 story in our view, because the fact that the guarantee is now out to September this year suggests that the M&A may linger for potentially to the back end. So I don't think we'll see them really return to the market with force before 2012.
So a bit of moderate to slow growth going forward.
Yes.
For the sector as well.
Well, for the sector, I think for the guys that are well poised, they will do well, and for the others, they will. I think some of their weaknesses will show through the year.